Hi traders, I think one of the big talking points from clients at the moment is the breakout that we've seen in the US dollar on Friday, a fairly defiant statement by the market. Now we've been seeing that dollar index, the Dixie, effectively trading in a very narrow range for some time. Volatility has been compressed, and you can see those Bollinger Bands really coming into some of the tightest levels really since January of 2022. Now, we have seen the market break out. We saw a price close above that upper Bollinger Band, and traders are asking, can this continue? And ultimately, what's caused this situation? Now, I think if you subscribe to the US dollar smile theory, which shows the left-hand side working quite well at the moment, that is that the US dollar outperforms in a global growth slowdown. You can see that across different metrics. Now, I think inflation has seemingly taken a bit of a backseat. If you have a look at my inflation matrix, which looks at official inflation data, PCE, CPI, those kind of factors. If you have a look at survey-based levels of inflation and also market-based levels of anticipated inflation going forward, you can see most of those are pretty much below the 20th percentile of the 52-week range, and obviously heading in the right direction. It's really some of those sticky measures that are still very, very much elevated and grinding and painfully slow. But ultimately, we've got a situation where expected inflation is moving lower, and that should allow the Fed to pause in June and maybe stay higher for longer for a period of time. But I think it's really the data that's come into fruition. We obviously saw that last week. People were looking at PPI numbers in the US. People were looking at the senior loan officers survey, which showed a slowdown in credit, and obviously those lending standards are tightening up to a sufficient degree. We've obviously been watching what happens in bank deposits, which fell another 13 billion last week, and the tape and the equity that you can see in the KRE, for example, is still quite concerning. We've been seeing. In China, I think that's really been the epicenter. It's clear that the reopening trade, has fizzled out. Some of the data has come back. We've seen that in the credit data. We've seen that in the PMI data series in the MBS numbers and also Taishan. We've seen that in the import numbers and also the PPI numbers, which are in contraction now clearly. And the moves up we've been seeing in dollar CNH and also the bullish price action we've been seeing in the bond market of late suggests that China, liquidity is pretty abundant, but they're going to be exporting their deflation to the world. And that's a big new dynamic that really needs to be accounted for. But I think it's the global growth story, which is clearly under the microscope at the moment. We've seen that in the economic surprise indices Citigroup run. In March, we saw the US Citigroup Economic Surprise Index at 61. It's now at 6. In Europe, it's gone from 101 to negative 21. In China, it's gone from 162 in April down to 100. We've seen that in global manufacturing PMI numbers, which are in contraction at 49.6. You can see that in the copper price, which is breaking through those range lows. We've seen that in WTI price. And of course, the yield curve's been well established for some time. 2s, 10s have been trading in a negative 38, negative 66 range for a while. We saw 2s, 5s get up to about negative 27, and it's sort of been this gradual grind down to 54. The Fed obviously focused on this 3-month, 18-month forward rate, and you've seen that crater recently, which suggests there's probably a 100% chance of a recession coming through in the next 12 months. But clearly, the data is slowing down. You're not seeing that in the nowcast models. If you have a look at the Atlanta Fed nowcast models, that's currently running at 2.7%, but one suspects there's some downside risk. But it's clearly China, which is the epicenter of the market now, and that dollar CNH, I think, is really something that everyone needs to be focused on. The problem with what we're seeing with a global slowdown and growth is that it makes looking at data points and managing our risk just that little bit more troublesome. At least when there's a CPI print or a non-farm payrolls print where you're looking at average hourly earnings, you've got some finite points to manage your risk over. But when we're looking at global growth, anything can come through. It could be a housing start number, it could be a durable good number, it could be any kind of sort of hard data point that the market sinks its teeth into that perhaps 2 months ago no one really even looked at. So that means everything becomes available and the market looks at what it wants to do on any kind of given day. So that means managing your risk is certainly a bigger situation playing through. But at the moment, what we are seeing is signs that the global slowdown is coming through. Obviously, we're going to be watching what happens with the debt ceiling. If we go past the X date, and it looks like that's potentially going to be the case, and they have to look at prioritising and payments, that could extenuate the slowdown playing through, especially if it impacts Social Security, which is a big if. I think there's probably a small chance of that. But if we were to see payments being missed, that could extenuate the slowdown playing through. Now, I think in the short term, obviously the global growth is looking at that US dollar smile theory and it's supporting the US dollar. And so that factor is really, really key. So I think the growth very much over inflation at the moment. And so we're watching those data points to continue to see if this has got legs going forward.